Thank you everybody for joining us this afternoon. I'm very much aware that following our announcement last week, that will be top of mind for all of you, and rest assured we'll explain the background to our results in some detail shortly. But before that, I'd really just like to highlight some of the progress that Gattaca's made over the last few years. We're now the largest pure play engineering and technology recruitment specialist operating internationally, and working across both of these very substantial markets has enabled us to provide a compelling proposition to an increasing number of our engineering clients who are digitalizing their offerings and taking advantage of internet connectivity. Our engineering technology division is now our fastest growing business, with traditional OEM clients now requiring high-end software development and data analysis skills, and MatchTech being uniquely placed to provide them. Thanks in part to our international reach, our solutions business is now able to win mandates like the Unisys Managed Service Program, which we wouldn't have been able to bid for previously. After the acquisition of Networkers, we realised that our combined IT businesses lacked focus, and a year ago we announced the result of our strategic review and sales management restructure. We've seen constantly improving results from our IT business since that time, and this is continuing. We're now turning our attention to our telco business, which is dominated by a small number of telecoms vendors, and whilst we've benefited from upticks in their activity when they're doing well, we're also subject to great volatility when they retrench. Our strategy therefore is, as with IT, to identify additional segments of the telco market where growth is available and where we have capability. This involves diversifying our contract base away from the vendor community, identifying growth segments along with the strategic direction of our larger clients, and taking a more strategic approach ourselves to account development. In order to achieve our objective of becoming a leading player internationally in both engineering and technology, we've had to invest in people and process as well as some infrastructure during this half, as you'll see. So with that, I will hand over to Tony to take you through the numbers.
Okay, so if I take you through the headlines, net fee income was down 4% in constant currency. The engineering business was down 4% and driven by more headwinds than we usually have post-referendum. This was mainly felt in permanent recruitment, with contract NFI flat year on year. Most engineering sectors had challenges, with the notable exceptions of engineering technology, which was up 20%, and aerospace up 14%. In technology, NFI was down 5%. As Brian said, the restructured IT segment continues to improve, and we're now undertaking the same exercise with telco. As we announced on Thursday, the delays with turning the corner in terms of NFI growth and the investments we've made led us to the conclusion the full year profit will fall short of previous expectations. That said, we're confident that we can address the cost base and deliver NFI and profit growth next year. The integration of Networkers is now complete, with the final costs incurred in the first half, and we also confirm our commitment to our dividend policy and a maintained interim dividend. The income statement reflects what I've just run through. Revenue was up slightly at 1% in constant currency, but NFI down 4%, with contract NFI down 3% and permanent down 7%. Contract margins dropped slightly, 8.9% from 9.2%, reflecting some margin pressure post-referendum and the effect of some of our bigger contract wins and extensions. Overheads were up 3%, leading to EBIT down 24%. And on the next slide I'll go into more detail. So this profit bridge sets out what's happened between the 10.1 million profit last year to the 8 million this year. So across the top you can see how this movement is made up. NFI reduction of 1.6 million, overheads up 0.8 million, and a slight FX benefit. The decline in the UK NFI of 1.1 million, which is 0.8 million in engineering and 0.3 million in technology, which was probably not entirely unexpected post-Brexit and in line with our peers. That was broadly offset by savings in managing the cost base, which you can see in the fourth column. So 1 million of savings in staff costs, particularly bonuses, commission and share scheme, against that 1.1 million shortfall in NFI. The reduction in NFI of 0.5 million from our international offices was disappointing and reflects our over-reliance on too few clients. But we have continued to invest in headcount overseas, which has already started to diversify that client base, and we're confident of getting returns on this from Q4. We've also invested in central business development and the increase in our office capacities, as we've previously said. And if we look, other overheads are down 0.4 million, but we did suffer some one-off cost overruns of 0.7 million. They related to delays in moving into our new London office, investments in setting up entities to support the European pan-European contract win with Unisys, which we won last year, and delays in achieving some back office synergies. On the right hand side you can see the effect of FX was fairly neutral on us, whilst we get a benefit on the NFI line, because the overseas operations aren't a big profitable part of the business at the moment. We get the downside on the cost line. Now we've got the structure in place, we'll be looking to consolidate the central overhead base and ensure it's appropriate for the business going forward. If we move on, our effective tax rate, I said in the prelims that our effective tax rate would probably be around 35% going forward. The major impact from this is withholding tax when we do cross-border business into countries, particularly in Africa. This reminder that this tax is added to our charge rates, so we don't lose out, but what it does have is it does show up as a high effective tax rate. We are looking at ways of increasing how we recover some of that tax, and I can update you more at the full year results. The reduction in profits is reflected in the earnings per share, with underlying and basic earnings per share down 25% and 23% respectively. And whilst this is a disappointing period, structurally the business is sound and cash generative, so we remain committed to our dividend policy and declared a maintained dividend of 6p per share. If we look at the cash flow in the period, we generated 2.4 million of cash before dividends. This is slightly less than we'd normally expect, but reflective of the fall in profits. We expect net debt to increase in the second half due to the RSL acquisition we made just after the half year. Leverage will remain less than 2, and we're comfortable with that level of debt. We are cash generative, so we do expect that to come down after the year end. If we move on to debtor days are up slightly, whilst the UK debtor book remains good. Overseas overdue debts have gone up slightly, and we're focused on bringing that down. It's already started to come down, and we expect it to redress the position and get it back to where it was by the end of the year. So I'll pass back to Brian.
Okay, thanks Tony. So looking at the operational headlines, you can see our global headcount here, and I talked earlier about the investments we've made to create a scalable international business, and this comes across very clearly from the graphic. You can see that UK headcount hasn't changed, but globally it's increased by 26 across the 3 regions. This is enabling us to start to develop client relationships in engineering and IT to add to the clients we had in telco. And the proportion of engineering headcount in those overseas markets has increased by 8% since last year, up from 26% to 34% of the total headcount mix. I also spoke last time about our intention to increase the proportion of sales to non-sales staff. This has started, but it's only improved by 1 point, and our intention is to achieve a 75-25 ratio over the next 18 months, which will obviously have a consequent effect on central overheads as a proportion of NFI and improved profitability. Moving on to the two legs of the business, engineering first. As Tony said, it was down 4% in constant currency, and that's due entirely to a 12% decline in permanent placement revenue post-Brexit. So our contract income is holding up very strongly, and that's one of the reasons why contract NFI is our favoured revenue stream. Perm is historically more volatile and negatively affected at times of uncertainty, and that's what we've seen. However, it remains a highly attractive and very profitable business, and whilst consultant productivity has declined in the short term, we've committed to retain our experienced sales staff who will become more productive again as confidence returns. In the bottom right graphic, you can see that engineering is still a highly UK-centric business, but we're committed to rolling it out in our rest of world operations. And at 7% of total engineering NFI, we have made some progress since last time when it was 6%, but some way to go to get the mix of engineering NFI up to the same proportions as the mix of engineering headcount that I showed you earlier. But there's inevitably a lag between putting the investment in and getting the return. Looking at our engineering divisions, you can see that, as I mentioned earlier, over on the left-hand side, we've made continuing progress in our engineering technology business with contract NFI up 20%. This is where engineering, IT and telecom requirements for skill sets converges. Our engineering clients in automotive, aerospace and defence have now got increasing needs for software systems and electronics engineers. And Gattaca is uniquely placed to satisfy that demand with strong brands and specialist presence in both engineering and technology. So we've got consultants who understand engineering working alongside consultants who have access to those software development skills that our customers now require. A great example is a company called Sevcon, which is a long-established business, small business up in the northeast of England, who manufacture electric motors for the marine industry. In recent years, they've developed markets for their products in the electric and hybrid vehicles segment. And they've actually grown very rapidly over the last 18 months from around 60 staff to 160. Because of their size, they've got little or no HR infrastructure and were operating a PSL over 20 recruitment firms, which was resulting in frustrations, I think, on all sides. So we met with them and offered them a service under which we managed their recruitment requirements, gave them a mini site website where candidates can apply online, and basically help them develop their employer brand. I mention this by way of an example only because there are many companies like Sevcon out there who are perhaps too small to attract the attention of other MSP and RPO players, but where we see we can make a substantial difference. This is a firm who intend to add 180 staff over the next few years, and we'll be helping them to do that. And as I said, there are lots of Sevcons out there. The aerospace sector continues to perform well with NFI up 14%. This is another example of our strategy coming to fruition. We reorganised our sales teams a couple of years ago away from aircraft design because the OEMs have full order books and they're not designing new aircraft. We instead focused upon how individual airlines differentiate themselves from each other in the areas of cabin customization and the passenger experience, and that has worked. We're seeing the growth coming through. Gattaca Solutions, our MSP RPO brand, as I've said, is going very well. Sevcon was just the latest win, albeit a small one, but some of our larger accounts like Nats, Southern Water, Specsavers are all going very nicely. And Internationally, I've already mentioned that we're growing our engineering presence in the rest of the world. I was in Asia recently, where we now have a team of 8 staff under the MatchTech brand selling in recruitment services. And when I was in China, I welcomed the manager of our newly established engineering business in Beijing. That's a team of 5, and when I was back in the UK a week later, I got an email from her telling me that they'd already made their first placements. So huge appetite for what we do in MatchTech in China, and obviously a huge market. Moving across to the less good news, automotive was down 14%. Ironically, we now have more contractors out in the automotive sector than at any point in our history. However, that's as a result of winning a large MSP where we've inherited contractors from another supplier at very low margins to migrate them across to our payroll. We've also had a reduction in the permanent placement business that I talked about earlier, resulting in the NFI reduction. However, I'm pleased to say that that client is now getting busy again. They're ordering additional staff from us, and every new contractor that we put in is on commercial margins. So over time the mix will change, and we'll have more sourced contractors in that account, less of the migrated contractors. So the NFI negative will reverse and become positive. Maritime was down 18%. But again, there's better news in the pipeline. One of our biggest clients is British Aerospace, and they've got the Queen Elizabeth aircraft carriers coming back down into Portsmouth for refit. They've also got work on the new class of submarines and the offshore patrol vessels in Type 26 programs. So they've given us a requirement for up to 800 contractors, which they estimate will fall within our Q1 next year. That's the period from August through to October. Just to give you that in context, we currently have around 7,500 contractors out in the UK. So were we able to supply all of their requirement, we could actually see an uplift in our contractor numbers of over 10%. We're well placed to do that with our base on the south coast, with a 30-year tradition of supplying maritime skills. We're very confident that we'll fulfill a very substantial part of that requirement. Those of you who've followed Gattaca for a long time will know that infrastructure has always been the engine room of our engineering business. It's the biggest of our engineering divisions. And this is the first time I can remember it showing a negative performance. It's again a function of the reduction in permanent recruitment post-Brexit. We are seeing continuing high demand in the private sector, especially across highways, transportation and the water industry. But funding constraints in the public sector have resulted in certain projects being delayed. That said, as you all know, the government has signed off several very large public sector projects like a new runway at Heathrow and Hinckley. And when those sign-offs translate into job orders, we're very well placed in that division to get back to growth again. And finally, energy continues to suffer from the problems caused by the low oil price. However, we are seeing growth in renewables and transmission and distribution, and particularly on offshore and onshore wind programs. We're seeing a great deal of success across the UK and in Europe. So moving on to technology, you can see on the graphic at bottom left that it's a business of two halves. Half of it is IT, half of it is telecoms. You can also see, looking across bottom right, that it's a much more international business than our engineering business, which is a legacy of the way that networkers expanded internationally over the time that they were independent. We reorganized our IT business, as I said earlier, about a year ago, and broke it down into what we felt were the most attractive market segments. And as you'll hear shortly, we've seen some success in that area. So really, given the problems that telcos caused us in the last half year, we've taken the same approach to that and have looked at the telco market, segmented it into what we believe are very attractive and viable segments, and they're shown on the following slide. So what you see in the top row in the middle is that network infrastructure legacy business that I've talked about. Historically, we've followed these clients around the world, striking supply contracts on a country-by-country basis for the same skill sets, mainly involving the erection and maintenance of radio masts and towers. We need to elevate our service offering to those clients and basically follow them in the direction that they're heading. So companies like Huawei and Ericsson no longer see themselves as pure-play telco operators. They see themselves as technology businesses, and we've seen some of the very good hardware that Huawei have developed and launched in recent months. So we see an opportunity to build on what we already do in the OSS, BSS market, operating and billing support systems, and we've carved that part of our business out and built a sales team to concentrate on it so that we can track and monitor its performance, both selling into the telco vendors and the operators. A new opportunity that we see is to help those companies in their research and development areas through the provision of higher end software development skills. And further, we see a huge opportunity in the convergence of information with communications technology. So in effect, the mirror image of what we're doing in engineering with engineering technology, we're going to do from the other end of the equation in technology and IT. So we're targeting businesses working in the cloud computing and digital transformation space, supplying customer-facing staff like technical salespeople, solutions architects and product managers. And again, we found a really good niche in disruptive technology businesses, tend to be SMEs, companies like Sigfox, which is a French IoT firm, and Tele2, part of the Swedish Kinnevik group. So that's how we're addressing the issues that we've had in telco. And moving on to the overall technology performance, you can see that there are many positive signs. The growth drivers box is bigger than the challenging box. I have to be candid and say that's because a lot of these businesses on the left-hand side are very small, and therefore it's much easier to show decent positive growth trends. However, in many of them, we've already got a good position, for example, in IT leadership and ERP. So these are substantial businesses where we are seeing growth. And as I said, the IT business in total, we expect to get back to growth in this half year. The challenging accounts include our corporate accounts. This is a largely public sector business which has been affected by the price caps imposed by the National Health Service. Digital development was down nearly 30%, which was a client-led issue where two very large clients reduced demand. And telco infrastructure down 9%. I've already talked about the over-reliance on a small number of large vendors. So that really reviews our operational performance. I should just mention that we, as Tony said, that we acquired a business called Resourcing Solutions Limited on the 2nd of February. This is a bolt-on acquisition that complements what Matchtech does already in power, the built environment, and in particular the rail industry. Rail recruitment makes up about 80% of the business, and as you know, that's a sector that's seeing heavy investment over the next few years. Matchtech's existing rail business is rather London-centric, whereas RSL is more regional and services network rail. So this deal gives us much better UK coverage and significantly enhances our offering to customers. We're planning to integrate the back office during our new financial year starting in August, which will achieve around £500,000 worth of synergies. So that's still to come. And that takes me on to the outlook. So we're now in a position where we are building brand awareness of Matchtech and networkers in the engineering and technology markets, both of which are huge and in which we're very well positioned to take advantage of growth opportunities. The refocus of the IT business is working, delivering improved NFI, and will return to growth this half. We've just undertaken a similar process in telco to address the issues we're seeing there. The convergence piece that I've touched on several times is a great opportunity for Gattaca. We don't believe anybody else is as well positioned as we are to take advantage of that. We have finalised the integration of networkers, and we're now turning our attention to making sure that we've got the right level of central costs. And the investment in international operations has been made, which will start to deliver NFI growth as our core engineering and IT recruitment services are rolled out. Gattaca Solutions is winning MSP and RPO contracts that were previously unavailable to us. And we're going to continue to make selective investments to support medium and longer term growth whilst keeping a careful eye on what's happening in the economy and making sure that our costs are well controlled. So, as I've said, we anticipate a strong quarter four. We're committed to achieving the ratio of fee earners to non-fee earners that I highlighted earlier. So with NFI growth to come and a reduced back office cost base, we're highly confident that our results will improve sequentially from this point on. Thank you.
Right, thank you very much, gentlemen. Right, number of questions, so let's dive straight in. First one, probably for you, Brian. It's good to see the lengthy integration of networkers has been completed. Have the challenges faced in that process in any way changed the Gattaca strategy going forward? And it's always good to have hindsight, but in retrospect, did the integration work, the change of name and branding, and also the bolt-on of RSL in any way distract management resource in what was a difficult period for NFI trading?
I think the acquisition of networkers was a big learning curve for us. It was far and away the biggest transaction that the company had ever made. Previously, I think the largest acquisition we'd done had a consideration of about £4 million. This was £60 million. It was an international business. Matchtech had no experience of working internationally. So it was a daunting and complex project. I think we probably underestimated just how difficult it would be, and underestimated the impact it would have on our management team in carrying out their day job and also an integration. So we learned a lot of valuable lessons from that, but we probably lost 6 to 9 months before we recognised that we needed to bring in extra support, contract project managers to help us complete the integration. So yes, I would agree that the acquisition was something of a distraction, but equally I would argue that it was imperative that we internationalised our business, reduced our dependence on the UK economy, as we've seen with the problems that the Brexit vote has caused us. That said, I think that the other items you mentioned, the branding change in RSL, haven't been a distraction at all. And in fact, the branding decisions and implementation have been a very positive thing for the business.
Thank you. Right. Again, on strategy, we have a question perhaps on focus of misfortune, but your two chosen core sectors have faced headwinds in the last year or so. Do you remain totally confident that these are the right segments to focus on? And what are the chances, if any, in the future of perhaps an acquisition adding an additional leg of the business to engineering and technology?
No, I think our strategy is very clear that we want to be the leading player in the markets that we've chosen to operate in. And both engineering and technology have enormous growth prospects and are very substantial sectors. The technology recruitment market is worth 57 billion US dollars. Engineering's worth 26 billion. Our turnover is, 600 million. So we can build a very, very substantial business just by focusing in on the markets that we're concentrating on. So I think it's highly unlikely that we'll diversify away from those, although as with engineering and engineering technology, we'll always be looking for new opportunities within those markets.
Right, thank you. Now, this one looks for you, Tony. Could you remind our audience as to your considerations when you are looking at the level of total debt and what you deem appropriate? And could you also say how important looking at debt level is when you are setting dividends, i.e. I assume it's not just about earnings cover?
Yes, certainly. We're a contract-driven recruitment business, so we're never going to have huge positive cash like some of the more perm-driven businesses. So we're always going to carry some debt. Gearing of less than 2 times EBIT we're comfortable with, and even at the current results we will be probably about 1.5 times. So we're comfortable with the level of debt. We do take it into consideration with the dividend, but we don't see that as a restriction. So yes, we do take it into account, but we are comfortable with the level of debt. Both businesses are cash generative, so we do expect that debt to come down over time.
And in relation to dividends?
Well, the dividend cover, we do take it into account. Dividend cover, we've said we will target dividend cover of 2 over the cycle. It will drop below that this year as it did in 2009. We'll continue to rebuild cover going forwards, but at the moment, as I say, we're comfortable.
Thank you. Perhaps back to you, Brian. Politics, health of economies are clearly factors in your business that are completely out of your control. But what is top of your adjustment list internally at the moment that you want to reset and correct and avoid having to give another adjustment to expectations?
Yeah, I think I'd return to the point that Tony made when he took you through the profit bridge. When we saw NFI from overseas operations going backwards earlier in the year, the easy thing to do would have been to say, okay, it's not going as well as we planned. Let's take headcount out, reduce costs, bring costs into line with NFI, and make the best of a negative growth period. We didn't do that, and we didn't do that because it would have been the wrong thing to do. We were overly dependent upon a few clients. We do need to diversify the business that we acquired in order to make it scalable, in order to make it significant. I want to be in the position that some of my competitors were in earlier this year, of telling you as shareholders that, look, the UK is not in great shape, but look how well we're doing over here in other parts of the world. We weren't able to do that because our business currently isn't big enough and is imbalanced towards one sector and a couple of clients within that sector. So we had to make investment. It's been made, and now, to answer your question, it's my job and my management team's job to make sure that the growth comes through and we get a return on that investment, which we fully expect to see from Q4 onwards. We've got a very positive forecast for Q4. Fortunately, Q4 was too late to make an impact on this year's numbers, which is why we made the announcement that we made last week.
Thank you. Now, perhaps back to Tony. Recruitment revenues are notoriously short on visibility, but could you a little bit more about how visible revenues are from a board perspective? Are you informing the board on a weekly or a monthly basis? We have seen this year different themes of from the solid update given at the start of February to the profit adjustment last week. So anything that you can tell us about the process would be reassuring.
Okay. We announced the first, obviously the solid trading update. That was referencing to our peer group. As we said, contract NFI was fairly resilient, and we forecast internally. The operations teams forecast every 2 weeks, so we collate their forecasts looking forward. As you say, it's notoriously short visibility in recruitment. We collate those. We report them to the board every month, and I would say that, as Brian's intimated, that the thing that's happened is it wouldn't have taken much growth in the second half of the year for us not to have made the warning last week. As you move forward and some projects get pushed back, it was very, very tight. It could be that if we had a stonking quarter four, we may have got away without having to. So visibility is short, and we do obviously update our figures very regularly. But so this is more about anticipated NFI growth not coming through as quickly and it turning the corner as quickly as we thought a couple of months ago.
Thank you, very helpful. UK infrastructure, as you mentioned, Brian, is clearly going to be a very fruitful area for Gattaca eventually, as we are already saying, there are political hurdles. So could you just give a little bit more guidance on when you think these projects might actually generate an income stream that will be visible at the bottom line for Gattaca? And also, could you just cover a little bit more detail on your expectations for work that will arise from Heathrow Run 3? And then lastly, sorry for three questions at the same time, a little update on whether HS2 is being materially delayed by the CH2M contract discussion that's been going on lately.
It's very difficult for me to answer those questions. We're in the hands of the government. We continue to be in a period of austerity. The government says that it wants to go ahead with these big projects. We've seen in the results of our consulting engineer clients that they too aren't seeing that promised flow of requirements coming through. So I can't give you any timetable for when that might happen. What I can say is that infrastructure has for many years, since the recession in 2008-2009, been a business which has delivered a double-digit growth, and this year it hasn't. It's gone slightly negative. I don't expect that to be an ongoing phenomenon. I do think that it'll turn around natural course of events. We've been hit by not just Brexit-induced difficulties, but the decision of the new London mayor, for example, to take £1 million a week out of TfL's contract labour spend. We've had headwinds in the public sector with the changes to 35 rules. So I think we've had a succession of issues that have specifically affected our infrastructure business, many of which are non-recurring, and whatever happens with these big high-ticket projects, I think we'll get that back to growth because it's fundamentally a very good, very well-managed part of our operations.
Great, and just time for the last question. Again, on networkers, you've now reached the very attractive position of being able to properly exploit the opportunity. Are you happy? Are you more happy or less happy than when you actually bought the business in terms of the revenue synergies that you can now see in front of you?
Yeah, I'm disappointed that we haven't made more progress with the business since the acquisition. As I said earlier, it's taken us longer to finalise the integration than we had anticipated, but we're certainly, and again I've made reference to this, now picking up business and winning large accounts that in isolation neither Matchtech nor networkers would have won before. And again, you know, we've incurred the costs, the professional fees in obtaining licenses and creating entities across 9 countries in Europe in order to enable us to supply staff to Unisys in those countries legally and in a compliant manner. That's a sunk cost. Until we get to that status, we can't actually generate the revenue from the contract. By the end of this quarter, we expect that process to be completed. This is a 5-year contract with a 2-year extension, so we will recover the cost we've incurred. And more importantly, we'll then be in a position to supply not just to Unisys across Europe, but to all of our other customers who have requirements on the continent as well. So, you know, that's a great step change in the capability of the company that we would had we not made this acquisition. So I'm very pleased with what we've done.